Welcome to our third quarter investment outlook. The second quarter ended with a lot of excitement on the heels of the June 23rd Brexit vote that caught investors quite off guard. What happened with the Brexit vote really just added to the list of macro concerns that investors have been plagued by all year, starting with the concern over Chinese growth rate, followed by the concerns over the Fed raising rates too much. Bottom line is discomfort really is the new normal. And the root of this discomfort is ultimately a lack of growth around the globe. If you look at the global GDP growth rate historically, up to 2008, it's been 3.4%. Since then, it's been 2.1%. In this chart, what we've done is we've tried to plot the major economies, given their relative position for growth and size and the direction, whether either expanding or contracting and how much. So the way you read this is starting with the U.S. growing at about 2%, and the expectation for year-over-year growth is to decline by about 0.2. If you overlay the major economies then, looking, for instance, at the European bloc, growing at somewhere around 1%, trending down slightly year-over-year. UK growing at about 1%, also trending down. China standing out here as one, nominally growing at about 6%, but declining at more than 0.5%. India out here at 8%. The point is that most of the world economy, based on size, is right around here, clustered between 0 and a little over 2% and directionally slowing. If you take a look at what the impact of Brexit was, our guess is it just shifts the trajectory slightly to the southwest here. In other words, diminishes growth rate slightly, therefore revision activity slightly more negative, because at the end of the day, at least for now, what Brexit does is it introduces more uncertainty and therefore diminished confidence, particularly business confidence, that impairs spending. We'll see if this is a big deal longer term, but in the short term, it just is one more thing to dampen investor confidence and sentiment. Given the slow growth environment, interest rates continue to be exceptionally low. This last quarter, we saw rates again around the globe hit all-time lows. Plotting the yields here in France and Germany, you see that yields, you have to go out beyond 8 years in France to get a positive return. Germany, 10 years out, is a negative still. It's less than one. In other words, if you loan the Germans money for 10 years, you will have less money in 10 years when you get your money back. It's amazing, very extraordinary. Japan, the same case. If you take a look at the yield curve in the UK, it's actually a positive return. You get about 85 basis points right now on a 10-year UK bond. And the US yield curve, it's the highest of all, of course, here. As we record this, the yield on the US 10-year is about 1.4%. Collectively, all of these low rates, because of very aggressive central bank monetary measures to try to stimulate growth in these parts of the world, is serving to drag interest rates down here in the U.S. The punchline is, given the state of the U.S. economy, the U.S. economic conditions are such that if not for this global environment, rates would be about 2.8% or twice as high in the U.S. as they are now. But the fact is that the slow growth around the globe and the very aggressive monetary measures around the world are going to keep a lid on U.S. rates, because capital is leaving here and coming here, serving to drive our rates down. Now, our Fed would like to raise rates. They like to, investment jargon here, normalize rates, meaning have higher rates such that when the U.S. does ultimately falter and we enter the next recession, or there's some sort of shock, that they would have some point from which they could lower rates. But now we're barely a quarter on the Fed funds rate. There's really no room to go. And we just don't think that's going to change anytime soon. Corporate bonds continue to offer value in this environment. That's been very rewarding, and our fixed income team continues to shy away from treasuries and underweight those. They're extraordinarily expensive. They still find value in corporate bonds. Shifting to equities, for stocks to go higher, we've been talking about this for more than a year. It's all about earnings. What we've plotted here is actual earnings on the S&P 500 in solid blue. Last year, the collective 500 stocks in the S&P earned $116, essentially the same as the year before, and thus stocks went nowhere last year. Right now, consensus expectations for 2016 are $118, barely a 2% sort of year-over-year growth. We think that this estimate is too pessimistic. The reason we think that is last year, rather than earning $126, and we instead earned $116, it was because of the combined forces of oil falling 31% and the dollar appreciating 9%. Combined, those two macro forces serve to take about $10 out of S&P earnings. As the headline suggests here, what were headwinds last year have become tailwinds. Specifically, as of June 30, Year to date, oil is up 33%, and the dollar is down 3%. So those macro forces that hurt earnings last year, we think are actually going to be accretive this year and help earnings. And we think that expectations and revision activity from this point is going to start to be positive, and that will help stocks climb higher as the year progresses. In terms of asset allocation, if we take a look at the valuations of the major equity asset classes, you can see here we've plotted PEs based on forward-looking earnings. Small cap stocks being the most expensive at 20 times earnings, large cap stocks trading at slightly above average multiple of 16 times. International stocks are the inexpensive portion. Developed market international stocks trading at 13 times earnings, and emerging market equities trading under 12 times earnings. To remind you where we are in asset allocation, we're very modestly overweight large cap stocks US. In the first quarter, we took money out of small cap stocks and invested that in real estate. And in terms of international equities, as the headline suggests, we think they offer value. The reason why we haven't abandoned international equities or gone underweight is though they are cheap, and though Brexit introduces greater risk, we think that the Brexit risk has now provided more likelihood that there'll be fiscal stimulus to go with a monetary stimulus. So stocks are cheap, and we think we'll get some catalyst there. So we're neutral in terms of our allocation over all the international equities, but within international equities, we're overweight emerging markets. And this is a departure from where we've been the last couple of years, given concerns about the Chinese growth rate and the linkage to many of the emerging markets. We've been underweight emerging markets. That was the right call. We've now gone to modestly overweight there. Those areas are very cheap. And we think they've hit bottom. We think if the dollar continues to not appreciate, that's also going to help them. So that's where we see value in this market. And of course, bonds trading at all-time highs. There's no value there other than as a defensive measure, sort of an insurance policy, if you will. In terms of the election, it's hard to say what's going to happen. It's been nothing but surprises, of course. But the consensus expectations here are for a Democratic president, a Democratic Senate, and the Republicans to hold the House. We've assigned probabilities to the three other possible outcomes, but we don't think at this juncture that the election is going to be a capital market event. Rather, it will pose some risks and opportunities for discrete industry groups. Specifically here, we've tried to indicate who we think the winners and losers are in the different scenarios. One thing to note, across the board, we think defense is going to be a good place to be, and as such, we've been overweight those in our industrial sector. We'll see how things play out here, of course. This is a very static environment, but this right now is our base case. These are the industries that we think will benefit. This is the industry that we think will suffer. To wrap up, as we enter the third quarter, we modestly favor stocks over bonds. That overweight is in the form of large cap U.S. stocks. We're neutral in small cap stocks, neutral in international. But within international, we favor emerging markets over developed markets. Again, that's a departure from where we've been in the last couple of years. Commodities, we continue to be underweight, the exception being energy. We continue to be overweight energy. And finally, real estate, as we mentioned just 2 slides back, given a low growth, low interest rate environment, we think this is a positive backdrop for real estate, and we recently upgraded that to neutral. Thank you so much for your time and attention. We hope you have a great summer, and we look forward to catching up with you in the fall.